Can't get your hands on an unsecured loan because of the strict lending and high interest rates? The best alternative may just be invoice finance, which could help you unlock the capital tied up in your accounts receivable and release some much needed cash flow. Hi, I'm Peter Nicolau, founder of P Capital, an independently owned and operated commercial finance brokerage firm. As I'm sure you might know, there are a lot of businesses that can offer their customers the option to pay for their purchases using credit terms. This means that the customer can take up to a certain number of days to pay for their purchase without incurring any interest or fees. Having payment terms on invoices means that these accounts will often not be settled for a month or more after the product or service has been delivered, which could lead to cash flow issues for your business. If you're going to offer payment terms to your customers, you need to make sure that you implement a plan that will help you avoid these kinds of cash flow issues. But sometimes you might find yourself in a position where things don't go according to plan and you need to take out a loan to help with your cash flow cycle. There are many funding options for business owners within Australia. Different types of business finance is available and suitability depends on a number of factors. These include the size and age of your company, its turnover, the level of debt and assets, and the industry you're in. You could apply for a secured or unsecured loan, but getting your hands on either one of these loans can be a challenge. With secured loans, you need property security. With unsecured loans, you don't need collateral, but the lending criteria is quite strict and the interest rates are generally quite high. Invoice financing, on the other hand, is a unique alternative that doesn't require property security and can give you access to immediate cash without having to jump through too many hoops. Basically, it's a way for you to borrow against your outstanding invoices. Here's an example. You've supplied a product or service to another business, and once you've delivered that product or service, they have up to 60 days to pay their invoice. During this period, you can access up to 95% of your invoice value as a cash advance through invoice financing. Then, when the invoice is due, your client pays the funds directly to the lender. So the invoice essentially serves as the security for the lender. Some lenders even offer the option that allows you to outsource your collections and account management to them. So they'll collect the funds from the customer, repay the loan advance, and transfer the balance of funds to you minus their fees. The most compelling benefit of invoice financing is that you can boost your cash flow by leveraging your current debtors. It's also a pretty quick application process and much quicker than obtaining a secured business loan, so you can access the funding as soon as possible. And unlike secured and unsecured business loans, invoice finance is accessible to the majority of businesses. Even if you have a low credit score, a short trading history, or have been rejected for a business loan, there's a good chance you'll qualify for invoice finance, as the lender's ultimate risk is with your debtor. So, it's pretty flexible. There is, of course, some level of risk for the finance provider because there is always a chance the debtor won't pay their outstanding invoice. So most lenders will only issue an advance against invoices that are issued to creditworthy businesses, which is something you should keep in mind. Lenders also don't want to see a concentration of debtors, otherwise they may reduce their advance rate. And then it also comes at a cost. All invoice finance providers will charge a fee. This is usually a percentage of the value of the invoice. With all that in mind, is invoice finance right for your business? Well, only you will know whether it's the right cash flow solution for your business. But you may want to seek advice from a qualified broker before making the decision to use invoice financing. You could speak to the bank, but they might only have one solution they provide, which may not fit your needs and generally only provide facilities over a certain loan amount, which limits who can actually benefit from their facility. You want a broker that will go to bat for you. Here at P Capital, we back you, not the lender. So if you want to find out more about invoice financing or other lending options for your business, feel free to reach out today.